Thank you so much for joining, members. We will start the session in less than a minute. All right, we are ready to begin. Hello everyone, I am Kavita Agrawal. Thank you so much for joining today's session. Today we are talking about how to manage our active portfolios. Naturally, active portfolio management is a daunting task. It can be scary and it can be very challenging at the same time. If done right, it sets you on a path to generational wealth. If done wrong, it can also take you the reverse path to poverty and debt. So let's go over the presentation I have prepared for you today and discuss different strategies, different things to look out for, the kind of mindset that you need to be in order to manage your active portfolio, what are the advantages of active portfolio, and of course, what does active management of portfolio mean? So we will cover everything from the very basic to high level as much as we can within, a 30 to 45 minute time frame. During the session and at the end of the session, I will also be answering your queries and questions. So don't hesitate to drop your comments. I will also try to respond to your stock queries during the session if possible. But during the session, also don't like to give a thumbs up to this stream if you enjoy it. Now, I will share my screen and we will get started with this session. All right, just give me a second to fix that because that is not the window that is supposed to be visible to you. There we go. Okay. So, the strategies and the best practices that we will be talking about will help you to optimize your active portfolio. It will help you navigate market fluctuations and achieve your investment objectives. Now, whether you are a seasoned investor or you're just starting with your investment journey, this entire session is aimed to equip you with the right and necessary knowledge and tools to make informed decisions and maximize your gains. Now, understanding active portfolio management. So what is the definition of active portfolio management? Active portfolio management means when you take your capital and you start churning it in the market with the intention of beating a benchmark. What do I mean by beating a benchmark? Basically, beating the benchmark means generating more return than any of the indices that you may have opted for. If you are someone who trades across all different kind of stocks based on market cap, then the Nifty 500 would be a better benchmark for you to compare your active portfolio performance. If you are only trading actively in the large cap stocks, the Nifty 50 is a better suited index or benchmark for you to measure your performance against. Now, what are the key characteristics and advantages of active management of your portfolio? The first thing is flexibility and liquidity. When you're actively managing your portfolio, you need not commit your capital for a very long term, which may be many years. If you have capital availability for a relatively shorter period of time, which can be say few weeks to few months, you can go ahead and commit that to the market. However, active portfolio management or active trading requires a lot of expertise in stock market policies, business analysis, and financial analysis. Other advantage of active management is that even if you have a relatively smaller amount of capital or limited amount of capital, you can churn that capital multiple times in order to generate capital. It helps you reduce redundancies, because in the buy and hold strategy, a lot of times people get carried away with only entering stocks and they don't focus much on the exit strategy. But in active portfolio management, you are forced to have your exit strategy chalked out beforehand. Now, if you think you are doing active portfolio management but you are not taking care of the exit strategy, then in the upcoming slides we will discuss in more details about how to get hold of that particular mindset and how to go about it in a step-by-step manner. Moving on, then active portfolio management obviously helps you with diversification and risk management, or rather diversification and risk management are very important components of active portfolio management. If you're not properly diversifying your portfolio among anything between 8 to 15 stocks, then you're probably concentrating your capital too much in one single or over a few number of stocks, which will lead to drawdown when the market turns against you. Now, there are so many different types of risks in the market that it's impossible to navigate all of them at the same time. So you have to assess your position from a perspective that you will experience some risk or the other, and in order to mitigate those risks, it is very important for you to diversify. Now, diversification itself has some disadvantages when you're doing it too much. For instance, if you're allocating 1% capital to every stock, which means you're probably holding nearly 100 stocks in your portfolio, then even if a stock moves up very significantly, it will not give you a lot of capital appreciation. So diversification is a very useful tool, but it has to be done carefully. Risk management is very important, but along with that, you also have to keep in mind capital management is also very important. Moving on, setting investment objectives. So in order to be successful in active portfolio management, you should start with setting your investment objectives. This is nothing but firstly defining your financial goals and your risk tolerance and making sure that they are very realistic. Usually this first step can be difficult for beginners, so it's always advised to take help from a professional research analyst. Second, create a well-defined trading strategy statement. Now, if you are somebody who is experienced in the market and who has seen many ups and downs, then you probably know the importance of having a trading strategy. Now, trading strategy is one thing, but it's important to also have a trading strategy statement. Basically, what is it that you want to get out of the market and how is it that you're going to do it? The bottom line of trading successfully in the stock market is simply by identifying lows and identifying highs and doing what needs to be done, that is buying low and selling high. But it's easier said than done. What do you define your lows as, or what do you define your entry points as? What makes you think it's gonna enter? If you're doing it on the basis of gut feelings, then your capital is likely not going to last long. You need to have a strategy statement. For instance, I use indicators, I use technical analysis for my entries, right? So my statements look like, okay, I'm going to look for momentum indicators I'm going to wait for momentum indicators to give me a positive signal, and I'm going to wait for moving averages to confirm that before I start taking a position, or I'm going to look for confirmation from volumes on a certain time frame and look for confirmation on a time frame above or below this particular time frame which I'm considering to trade in order to draw my confirmations. Then this is about the entry. You also need specific strategy for your exits, so you need to start defining these, and it's always easier to define these basis experience rather than copy pasting other people's strategy, because in the stock market what works for others may not work for you. Thirdly, align your investment objectives with time horizons. When you commit yourself to a time horizon with respect to, say, returns, with respect to goals, you will stay the course. Otherwise, when it comes to active portfolio management, it is very easy to lose discipline and lose your track. You buy stocks, but if you're not monitoring those stocks, if you're not trailing those stocks, if you're not booking profits in those stocks, then what is the point? You're losing on opportunity cost, you're wasting your energy, you're wasting your time, where you're also wasting your potential, because you may take all of those resources and maybe put it towards your business, towards your job, and get more out of them rather than diversifying here. The whole objective or the whole idea of succeeding in active portfolio management, you should be to do it as a side business. So you have to stay committed, you have to have a plan, and you need to execute and monitor yourself. Let's talk about portfolio construction. So you've decided that you want to actively trade in the stock market. How do you go about constructing your portfolio? Firstly, diversification across sectors. Now, in the stock market, there are different sectors, and these different sectors are at different stages of cycles at different point of time. I'm sure you've heard the concept of cyclicality in the stock market. That is, not all sectors are trending upwards, not all sectors are trending downwards, not all sectors are peaking, not all sectors are bottoming at the same time. There is a concept of cyclicality. There is a concept of, firstly, sector rotation. So when you're doing active portfolio management with long side only strategy, you need to know which are the sectors which are turning up, which are in momentum, which are near the top, which are bottoming out, and you need to place your bets accordingly. Now, in the stock market, there are multiple sectors. So obviously it doesn't make sense for you to go after just one stock in one sector. You have to go after multiple stocks in the same sector, and you have to go after multiple stocks in multiple sectors. This will help you diversify, and in case something very disruptive happens, which is something that we should expect in the age of AI, your capital would be protected against sharp drawdowns. Now, for instance, today Gland Pharma has been falling significantly since the last few days. We don't know why, we just know it is falling. So if you go out hunting for the why, it's not really going to serve you any purpose except for the practice that you would have maintained at the time if you have active position in Gland Pharma. What would have helped you is making sure that your capital allocation is such that you're not overly exposed to that stock in relation to your entire capital. That's just one example. There can be a lot more. But let's move on. Let's talk about the next step in capital allocation strategies of the whole portfolio construction theory. We are talking about balancing the risk and reward. So a lot of times when people see some profit potential, they go after a position. That may not be the best idea. You need to decide how much is your time worth, how much is risking your capital worth for you. So for me, a risk reward ratio of minimum 3 is required for me to take the decision of executing a trade, hitting that buy button, risking my capital. I realize that this capital that I am investing in the stock market, or that I'm investing on behalf of my clients in the stock market, is post-tax income, which means after having paid nearly 30 or 40% tax, it's the money that I have got. So I will only go ahead and invest that money if I can at least get 3x of the risk that I'm taking with this money, right? Not 3x the return, I'm talking about 3x the risk. I'll explain with numbers. So for instance, if I identify a position where there may be a possible 3% downside that I may have to absorb, just to give the stock some breathing space so that I don't get whipped out, I would desire for at least a 9% potential target on that particular position if I were to make one there. So without a minimum 9% target, which is determinable on the basis of analysis, I mean, that's the whole point of being a research analyst, that I am at least on the basis of my own analysis able to identify potential targets and losses. Now there are so many things which deter these levels of target and stop loss. Like stop loss gets triggered, like there are false triggers, there's stop loss hunting which impact you negatively, there are trailing stop losses which may get triggered, which can take you out of a position before the target gets hit. There are many things, the economic condition changes, there are risks. So taking all of that into consideration, it is very important that we set a standard with respect to how much reward we want at the minimum before we risk any capital. So for me, that ratio is 3. You can have your own ratio, but for everybody, I do recommend not to go for anything below 3 risk reward ratio. So this does help you avoid over trading, which is a big vice in the market. Many people end up over trading, incurring a lot of trading charges without even realizing it. The next step that you need to be mindful of is you need to consider things like liquidity and volatility of a particular stock before you take position in it. So if you want to buy, say, 1 lakh rupee worth of stock, and if you're looking at a penny stock, not a very good idea. If you're looking at a large cap stock and you're trying to buy just 10,000 rupees worth of stock, it will not give you enough returns, because in a large cap stock, again, a 10% move is a very big deal. So you will need to allocate a bigger percentage to a large cap stock of your entire portfolio. So as a ballpark, I recommend that you keep the highest percentage allocation per stock for the large cap stocks, you keep a relatively lower allocation percentage for the mid cap stocks, and an even lower percentage allocation per stock for the small cap stocks, and avoid micro cap or penny stocks altogether for active trading purposes. Now let's talk about security selection. Now that we have the basic hygiene points out of the way, let's talk about security selection. The first approach to selecting which stock you should trade in should be fundamental analysis. So when you're active trading, you need to ensure, at least in my opinion, that the company that you want to trade in has its base clear, in the sense that there are no corporate, and try to ensure that there are no corporate governance issues, it is not experiencing a major litigation or a major technological disruption, because like I said earlier, it's the age of AI and there is no sector, no industry which is secure from it. But at least you should try that it's industry that the industry of the stock that you want to actively trade in is not getting disrupted left, right, and center by these technological advances. As an example, take the multimedia business. So PVR Inox is a stock that historically I have actively traded, but now I have removed it from my watch list, considering the way the industry is headed towards. With the advent of Netflix and other OTT platforms, multiplexes are losing business, and as a result of that, not a very good idea to actively trade in them, because firstly, long only strategies don't work very well in stocks which are experiencing a bear market. So that is why you need to ensure that at least these 3 things are out of the way and sorted in the stocks which you are planning to actively trade in. The second step would be technical analysis. Technical analysis is a great tool when applied to fundamentally sound stocks to identify potential entry and exit points. That by analyzing price trends, patterns, and market indicators, you put yourself in a position to identify accumulations and distribution points and take advantage of them to make anywhere between 5 to 40% returns per swing. There are stocks which trade which give 40 to 60% swings. There are stocks which give 5 to 8% swings too. Depending on your comfort zone, you can identify these stocks and trade. Now, security selection is a very tricky part of active portfolio management, whereas trade execution is another part. I usually recommend people to work with professional research analysts and professional stock analysts to rely on research analysts for the security selection and focus solely on the trade execution, because that itself is very demanding. So let's talk about active versus passive investment strategies. So in order to understand the difference between the potential benefits of each and ensure your suitability, what you need to do is you need to firstly take stock of how much capital do you have, and out of this total capital, what percentage do you want to keep as long-term investments in stocks which you will hold on for probably years, versus how much of that capital you want to invest in active management. Now, there is a rule of thumb for this. So usually for younger folks, it's better to go for more active management because naturally the risk-taking capacity is higher. So usually take your age and subtract that from 100. Whatever is the result is the portion of capital which you can allocate to active management, while the rest goes to long-term investments. Usually portfolio management and mutual fund investments, SIPs, ELSS schemes, so on and so forth, take care of the long-term aspect of your portfolio, and whatever remains, you can use that as active management or active portfolio management, active trading in the stock market. You also have to take into consideration your risk appetite. Now, with risk appetite, you should also have the risk taking ability. So for people who are very low, who fall in the lower income ranges, I suggest passive investing or index fund investing as something that is more suitable, especially for people who are just starting out in your career. At this point of time, instead of thinking about actively trading in the market, your focus should be more on skill building and skill acquiring. Trading in the stock market is also a skill, but your tilt should be more academic than money making, because once you start thinking about the money, the learning bit reduces. But for people who are more mature and want to start trading in the market now, I strongly recommend that you get associated with a research analyst. Now, for instance, I have a company called EXP-Invest, through which I help retail traders take active positions in the market with a time frame of 2 weeks to 6 months. Now, there might be multiple services, not that I'm aware of any, but there are also individual research analysts who can help you out with your portfolio, including existing portfolio and creating portfolio of stocks where opportunities are ripe and momentum is waiting to break out. Portfolio monitoring and managing your portfolio. Now that we have spoken about the advantages of active portfolio, we've spoken about the basic hygiene points, we've spoken about how to construct. Let's talk about monitoring and managing. This is something that a lot of people fail at, because it is very easy to buy stocks, it is very easy to accumulate stocks, but it is very difficult to manage stocks. Now, okay, before I go into a bit more details of this, let me just take a quick look at the comments. We have Arish Shamsi, thank you so much. Good afternoon to you too. Thank you for joining. So we'll take the stock queries at the end of this session. So we have RJ. Why should long-term investor plus monitor his portfolio every week? So RJ, long-term investors do not need to manage their portfolio every week. Weekly portfolio management should be done by people having active portfolios only. However, long-term portfolio holders should review their portfolio every quarter, and if they don't have the sophistication or the research analysis angle, they should take help from a professional to do it every 3 months. Because if you're not on the right track, then you might lose your capital, you might lose unrealized profits. It's not, even with long-term portfolio, just buying stocks is not enough. You also need to know when to exit, and associating with a research analyst like myself can help you out with that. All right. Cool. So let's continue. Monitoring and managing your portfolio. Okay. Just one last thing. So in the comment, I am pasting the link to my Telegram channel for those who might be interested in getting in touch with me. There is a chat group associated there, and it's one of the best ways to get in touch with me. Alternatively, you can also email me at kavita@exp-invest.in. Right? All right. Now let's talk about monitoring and managing your portfolio. Firstly, regular portfolio review and rebalancing is very important. You bought a stock, the stock has rallied quite a bit, but you have not set your stop loss. Some bad news comes in from the US and the market comes crashing down. So does your stock. What happened? You're back at break even, or worse, your stock has fallen below your entry price. Now, those who are into active management of portfolio will have experienced this if they are not regularly reviewing and monitoring your portfolio. This mismanagement often leads to resentment, leads to greed, which ends up with you booking profit in other positions which should have been allowed to run, because they would have given more profits, or you end up buying other stocks which end up in losses. Or rather, this is in short called revenge trading. Resentment leads to revenge trading. Resentment comes from poor management of your active positions, poor improperly scheduled reviews, or absolutely absence of review. Assessing performance against benchmark also is important, because the whole objective of actively trading in the stock market is to beat the benchmark, right? And why is it important to actually compare yourself with the benchmark and not look for the performance in absolute percentage terms? The reason being that if you're not comparing yourself with the benchmark, then when the bear market happens, you will end up unnecessarily penalizing yourself or being resentful of your performance in the market. In the situation where if the market has fallen 6% in a month, but your portfolio has fallen barely 2%, you've actually outperformed the market. And this acknowledgement is very important, because especially in active trading market, the bear market, in actively trading the stock market, when the bear market or the bear trend comes, many people get demoralized and exit the market because they don't understand what is going on. And comparing your performance against the market, a benchmark, helps you stay in perspective. Risk management is another reason why monitoring and managing your portfolio is important. Implement risk mitigation strategies like stop loss orders. So like I said some time ago, when you enter a position, it is very important to make sure that you know your exit strategy. Understand that when you buy a stock, it only has so many places to go. It can either go up, or it can go down, or maybe it can stay sideways, right? So before you enter the position, it is very important to determine your target and your stop loss. Secondly, revising your stop loss and targets based on the price action analysis will also help you manage your position better. Like I just said, if you're not actively managing your position, if you're not actively trailing your stop losses, then you may lose your unrealized profits to market fluctuation, which can be a very painful situation to be in. Thirdly, consider the tax implications and expenses. You have to understand that short-term trading is taxed at a higher rate, especially when you're doing intraday trading. A lot of people do not understand that and indulge in intraday trading, which not only increases their tax payouts when they're profitable, but it also adds on to their expenses, which can be harmful. There are also there are things that you can also claim during your tax filing if you're profitable as expenses or rather trading expenses, especially when your volume is high enough to be for the whole year for the whole trading to be considered as a side business. Lastly, it's very important that you consider ways of reducing your costs and slippages, because costs and slippages are a very good way of eroding the profit which you think you might have created. If you're not being mindful of what expenses you're incurring or how much profits you're actually losing to slippages, you will not be able to optimize your position and increase your or improve your performance over time in the stock market. Now for a moment, let's talk about psychology. I think I might be covering the screen a little bit there. Give me a moment to fix that. All right. The psychological aspect of portfolio management. Now, emotions and biases in trading and investing are is what makes the whole active portfolio management very complicated and very difficult. We all know about the two basic emotions which kick in when we are trading, that is greed and fear. But in addition to that, there are a lot of other biases which differ person to person depending on their personality. You might have heard of biases like herding bias, anchoring bias, recency bias. All of these can play a major role in your trade executions in the stock market and decision making. The only way of identifying and dealing with these biases or working with these biases is by analyzing your own trading pattern against the performance of the market. I have done multiple sessions on this topic, so I will not elaborate too much on this. However, if you are interested in knowing about this, you can go to my YouTube channel EXP-Invest in and EXP-Invest.in. And you can find out the past sessions that I've conducted on the topic of trading psychology. Now, staying disciplined during market fluctuation is another very important aspect of portfolio management, because like I said, sometimes people get emotional and engage in what can be only termed as revenge trading. That is not a very good idea because it incurs more costs, it makes you do the wrong thing, it makes you take emotional decisions, and the stock market is honestly a very difficult place to be emotional in. Also, it's also a very bad place to exercise hope. You should always aspire for objectivity and work with objectivity of your mind, your decisions, excluding or leaving emotions and hope entirely out of the picture when you're dealing with active positions. Now that's all I have in this session. I hope you found this session useful. If you have any questions, this is a great time to put it down in the comments. I will now move towards chart analysis and help you out with your stock queries. So if you also have stock queries, you can also feel free to put them down in the comments. And as I move forward, I will take them up and with the help of charts, try to provide you with stop loss and targets. All right, let me share my chart screen with you now. All right. Let's take a quick look at the comments. What have we got? So we have Ashu, and he was asking for recommendation on Reliance with a time frame of 2 to 3 weeks. Let's see. So Reliance recently has started to give a rally from the level of 2200 and taken resistance at 2500. Let's see. So in Reliance, honestly, I've been steering clear of this stock for the time being, since there is a massive negative divergence on the weekly time frame, and that makes me very uncomfortable to take any active positions in stocks. So my target on the downside on Reliance is around at 2000 to 2100. So that is where I would prefer to take an active position in the stock. So Anshu, I am guessing that you already have a position, and that is why you are asking for the view for 2 to 3 weeks. So considering that the 15-minute time frame is showing strong momentum for the time being, I would recommend you to use a stop loss at the level of 2431 on Reliance, which is right now trading at 2455. And on the upside, I would recommend a target of around, basis the momentum, it does look like it can attempt to retest this target of 2731, right, which would basically mean retesting, but that's actually very, very optimistic to say that it will come back and retest the high. Actually, yeah, that's more realistic considering multiple factors. So 2600 is what I believe your target should be on the stock for now. All right, moving on. So RJ, I've already answered your question. So we have Sajanji, he's asking about Tech Mahindra, Tech M. All right, let's see. So I'm personally very bullish on Tech Mahindra, and the stock has started off with a very good momentum. In fact, Tech Mahindra is one of the stocks where I have an active position for my swing trading clientele, where I tell them which stocks to buy at. So I have given an active call in Tech Mahindra right at 1000 rupees, which is close to the recent low that it forged. Now I don't want to get into the technical details because it can get too jargony for a lot of the attendees. So the short-term target on Tech Mahindra is near the level of 1152. Now this is a potential resistance level, and that is why I've kept a target there. However, if the stock comes close to say 1145 and I see potential, then I will be extending target on the stock. But for now, I will go with the level that I just stated. And on the downside, I believe that a stop loss at the level of 1075 would do good justice. All right, so that's that. We have Aries again asking for analysis on IRCTC and TCS. So let's start with IRCTC. Now IRCTC looks very attractive for the long term, but the near term prospects are a little unclear in IRCTC. However, if you're looking for a stock for long term perspective, this is a good candidate for that. At the current market price of 623, I would go for a stop loss of 603 with the potential target. I was actually analyzing IRCTC just a few days ago, and I think it has formed a pretty good base near the level of 559, right? But to predict a potential breakout above the level of 670 would be a bit of a stretch, so I wouldn't do that. However, I do believe that in this rally, the stock can give 10 odd percent of rally. It still has 9 to 10% of rally left in it. So you can hold 675 as a potential target on IRCTC. So today it has started to give a good move. So with a 3.5% stop loss, you can aim for around a 9 to 10% rally in this counter. All right, let's talk about the next stock, that is TCS. All right, let's see. So TCS is also giving a sort of a reversal from with a positive divergence, that is very positive. And I am also bullish on this stock. So I have been bullish on the IT counters since quite a while. And usually it is seen that when banking stocks start topping out, IT sector, that is when starts taking off. And if you've attended the previous sessions, I mean, I was not coming live since the last 2 weeks because I was traveling and was also a little unwell. But before that, the sessions that I took, I have been warning against making positions, fresh positions in the banking stocks, because the charts have been very clearly, the charts have been showing very clear signs of bearishness. So, you know, with banks going a little topsy-turvy, we have opportunities coming up in the IT sector. My members, my swing trading members have been given IT stock ideas like Tech Mahindra, but TCS has also been quite attractive on that scale. On that note, let's also take a look at Infosys. Okay, taking a look, let's move back to TCS. All right, so in TCS, if you have an active position, I would recommend you to use a stop loss, because the momentum we can see is pretty strong in TCS, and I would expect this to continue for multiple reasons. I would suggest you, however, to use a stop loss somewhere here. I mean, it is a slightly bigger stop loss, but I'll be able to trail this once the stock has given a very conclusive breakout above the level of 3310, which it hasn't yet. That is why the stop loss is slightly bigger, to give it some more breathing space. So here your stop loss would be at 3230 on TCS, and maintain a target of around 3385 on the stock. We have Mahesh Ji, he's asking for view on Kajaria Ceramics. So we have Aries, I hope you found the analysis useful. If you did, please don't forget to give this session a like. And that's that. All right, let's see. Kajaria Ceramics for Mr. Mahesh. Alright, so Kajaria Ceramics has given a pretty sharp move today, which is fantastic. However, I do feel like Kajaria Ceramics has reached its potential resistance zone, which is this blue trend line. If you can see it on my screen, I'm giving it a bit of a wiggle there. But I do believe this is the potential target. However, considering the momentum on the stock, I would not suggest you to book your profits straight away. Instead, maintain a trailing stop loss. Now, this stock, the biggest problem is that it has a tendency to give lots of downside spikes, sharp spikes like this one, which, you know, basically is stop loss hunting. Your stop loss can get triggered, but then there is no reason to not maintain stop losses. So I would recommend you to maintain a stop loss of 1206. Now, don't set a bracket order in the stock because of its tendency to give these spikes. But if you do see the stock sustaining below the level of 1206, I would suggest you to get out of the stock. Now, let's talk about the potential target. Now, if the stock sustains this, what seems like a breakout above this trend line, then the potential target for the stock would be somewhere near the level of around 1330. So if you're holding Kajaria Ceramics, Mahesh, I would suggest that you hold it for a target of 1330 with a stop loss of 1205. All right. Kanakraji, thank you so much for your kind words. I really appreciate it. So with that, we have come to the end of the session. It's 45 minutes to the clock, and I will take your leave now. However, I will remind you that I have shared the Telegram channel, my own Telegram channel link in the comments. And if you'd like to connect with me, that would be a great way. If you would alternatively like to connect with me via email, I am also dropping my email address in the comment section, and I'll be happy to hear from you. That's Kavita at EXP-Invest.in. Another reminder for you, if you want to book a one-on-one consultation session with me, where you would like to speak with me about your portfolio or your investment strategies, you can do so by using the link which the ET moderator will drop for you in the comments. Now, I'll take off. I will see you again on Wednesday with the Let's Get Technical series, where I bring to you technical charts and discussions based on that. Until then, have a great week. Happy trading. Don't forget to trail your stop losses. Namaste.